that wide shot real quick. Just so if you're watching our live stream right now, I want you to see this live shot of the studio. So it looks like we got Max Headroom hanging out with us this morning. So if you're in your car right now, if you're watching a live shot of our studio on our live stream, we bring in Mike Lebowitz. He's up in he's Nando from the north this morning, where it's really cold up in Washington D.C. But we bring him in on Skype so we can video him, and so we have this monitor in our studio that it's just his head on. And for all you youngsters, by the way, who don't know who Max Headroom is, YouTube it. You'll find it. So you'll get the joke later. And we always say, like, oh, yeah, that was funny. Morning.
Thank you, Lance. I love the intro.
Yeah, morning, Max. How are you?
Doing great.
So, yeah, it's a brisk 20 degrees. I see you got your sweater on this morning.
Now, aren't you supposed to say thank you for coming out on this very cold morning and talking to us?
Exactly. Thank you for showing up in your basement.
Yeah, what kind of commute is that?
Exactly, right.
It's a good 30 steps.
There you go. Then there's traffic, got dogs and everything else to navigate, so Stuff happens.
Legos.
Anyway, yeah. Good morning, Mike. How are you?
Good.
So let's talk a little bit yesterday. The Federal Reserve, Jerome Powell, making his statement on Capitol Hill yesterday. And, there wasn't, just real quick, there wasn't anything really, new or exciting about what he said. He didn't say anything earth-shattering. It's pretty much what we expected. We've written some articles recently that the Federal Reserve has now basically thrown the towel in on inflation. They are not going to raise rates again until they see a significant sustained improvement in inflation. Michael Lebowitz joining us live from Washington, D.C. See, it's more fun to say Washington, D.C. Just sounds more impressive. It's interesting, Mike, you're right there in the heart of the whole impeachment hearing process that's been going on for the last couple of days. So
miles from it, but so far from it.
Exactly. But speaking of government, I thought it was very interesting, and we alluded to this just for the break. Jerome Powell makes a comment that, it's really going to be important for the government to have a fiscal response during the next recession because, well, the Federal Reserve has already used up a fair bit of their ammo to battle the next recession. They've already cut rates 3 times this year. They were only at 2%, 2.25% on interest rates to begin with. So they've already given up a big chunk of that tool, to try to keep the economy going for now, which has limited their ability to fight the next downturn. They're already going back to expanding their balance sheet at a faster clip than they did during QE1. Back in 2009. So another policy tool that's been taken off the table. So it was interesting to hear him say and allude that the government needs to be prepared with some fiscal policy for the next downturn.
So what's fascinating about this is for the last year, we've heard from Powell. Bernanke has also mentioned it, by the way, but also from many other central bankers that we need to hand the ball off from monetary policy to fiscal policy, meaning that monetary policy, in Europe, negative rates, in Japan, negative rates, in the U.S., very historically extremely low rates, and QE on and off just about everywhere in the world is hitting its limits. And it's becoming obvious in Europe and Japan, and it at some point will become obvious here too. So what they're saying is our limits we're getting close to our limits. Hey, fiscal guys, that's, governments, Congress, you need to pick up the ball and you need to spend so the economy can grow. We can't put it all on our shoulders. And Powell has said this to some degree.
Right.
So yesterday, Powell warns that rising debt levels could impair the government from basically spending a lot of money during a recession. And he had the nerve to say that high government debt levels actually restrain private investment, which is very true.
Right.
That's what it does, which hurts productivity, and it by default then hurts economic growth.
Right.
Right. But
go ahead.
Go ahead, Lance.
No, just to your point, though, I just wanted to bring up this real quick point here is that we just got the first report on our fiscal deficit for 2020. The new we're now into the new fiscal year for the government. We had a $680 billion increase. It was a much larger increase in the deficit than what people had expected it to be. And this pushes us right up on the nudge of running $1 trillion deficit in an economic expansion. So exactly
let me stop you there for 1 second. The government will tell you that the deficit was 960 billion, 980 billion.
Yeah, close enough.
The amount of debt, the increase in the amount of debt was 1.3 trillion.
Right.
So, you know, I can tell my wife that I went out and only spent $40 on beers last night, but when she sees that there's $80 missing from my wallet, she'll know what I spent.
Right.
And that's the way to think about it. It's not an accounting gimmick. The government net, their debt rose by 1.3 trillion. This isn't a recession. And they're spending money like it's in a recession/depression type atmosphere.
Right. Well, and the problem, so now going back, and the reason I cut you off for that comment is to go back to what you said earlier is that, you know, if we do slip into a recession sometime in the next 50 years, you know, we're already running $1 trillion deficit. So now you're talking about pushing a $2 trillion deficit, the $2.5 trillion deficit, if you get into a more severe economic slowdown. You know,
right.
This is going to become problematic. And at some point, you know, one of the biggest fears for the financial markets, you know, we're running interest rates right now in the 10-year Treasury at 1.8, 1.9%. You know, if you start trying to push out, you know, another $500 billion, another $1 trillion worth of debt on a regular basis to try to fund your shortfall, there may well come a point that our foreign buyers, you know, China, Europe, Japan, et cetera, of our debt says, you know, maybe I don't want more of your debt at 1.8%. I think I need something like 2.5 or 3 or 4. That becomes extremely problematic for the economy.
Well, that's where the Fed enters. And I think that's what's going on now. The Fed knows that they have to buy the debt. Mm-hmm. They basically have to print money and buy the debt. And that's one reason we have QE4 today, because after the debt cap limit was raised, the Treasury issued a lot of debt, and there was no demand for it. There was demand for it, but just not at levels that the government and that the Fed would like to see. Mm-hmm. So what did they do? They basically started up QE4.
Well, you know, it's interesting you bring that up because this goes back to the whole kind of the repo issue that you and I had talked about earlier this year. Earlier last month when the Fed did start in, they came as well, we've got there's an overnight funding issue and it's because of tax payments. Interesting article out this morning that we'll find out which banks were in trouble in 2 more years. So in 2 years, they'll release the data that will tell us exactly who was in trouble and who needed money.
Right. But here's the bottom line. The Treasury hit the market for like $400 or $500 billion over the last couple months. And that basically, in order for banks to make the loans, for investors to buy it, net money had to be created. And that's what the Fed is doing. They are creating reserves so banks can loan the money to the government. And it's clearly unsustainable. And you have the Fed and every other central banker talking out of both sides of their mouth. The fiscal side has to take the ball from here. They got to start spending to boost economic growth. And then you see Powell warning that too much debt is a problem. And he's telling you the problem. He's telling you that too much debt causes slower economic growth. Is it any wonder that economic growth has been slowing for 30 years? Yeah. As debt has been rising for 30 years? It's because we're spending our money to pay back debt.
Right.
We're not spending it on innovation.
Well, and that was a very important statement that he did make, which was he came right out. I thought it was surprising because you haven't heard a Fed official say this before. He said that the U.S. economic growth has to grow faster than the debt. But it currently takes almost $4 of debt just to create $1 worth of economic growth. So there is literally no way that the economy can grow faster than the debt structure because everything the government spends, 98 cents of every dollar that comes in from tax revenue goes out just to pay mandatory spending, Social Security, Medicare, Medicaid, and interest on the debt. Everything else has to come from debt. So if you want to do an infrastructure program, that's got to come from debt. If you want to do a rebuild of the nation's grid work, or whatever it is, whatever program you want to fund, it's got to come from debt. So there's literally no way that the debt can grow faster than the economy because the economy is being driven by debt growth.
Especially when the debt is unproductive.
Right.
And we keep harping on that. If the debt was productive, meaning that it would create economic growth. So let's say the government hands out everyone $100. We're all going to go spend it. The economy will do great for a quarter or two, and then it'll get back to normal. But going forward, we have to pay back that $100 times the whole population. What if instead they said, we're going to take that $100 that we're going to give every person, and we're going to figure out a way to make cars go 10 miles more per gallon? Something, anything more productive. You can pick it. Well, that would pay benefits for years and years to come, which would help the economy increase, which would raise taxes, the amount that we, not as a percent, but just the amount of tax dollars, and it would lower the deficit.
Right. And look, there's historically good examples of productive investments. The Hoover Dam. Government spent money to build the Hoover Dam. The Hoover Dam provides power, which people pay for, which creates a revenue stream back to the government.
It opened up the whole Southwest. There wouldn't be a Vegas without the Hoover Dam.
Exactly. Tennessee River Valley Authority, another good example. So there are productive, and rebuilding a road doesn't create a long-term benefit unless that road opens up a new a new area of the country for innovation and growth, et cetera. But just repairing a road, once the road's repaired, you don't get a whole lot of benefit out of it. So, the government's got to figure out ways. If you're going to borrow money at 2%, you've got to have something that's going to generate a long-term return and pay it back. And unfortunately, every time we borrow money, we spend it on things like Social Security, Medicare, Medicaid. And not that that's a bad thing. It's just that doesn't, recycling tax dollars in the economy does not create economic benefit.
No, but they're crowding out private investment. And that's what Powell said yesterday. They're crowding out companies and people from investing in things that are productive because they need the money. They're taking it. They get pretty much first priority to it. And they are stopping companies and individuals from doing productive things with money that would actually help the economy and help the people of the nation.
Exactly. And by the way, the government just passed yesterday a new spending bill that will, make sure that we can keep the government running through December the 20th. Why? Because, we can't get a budget in place. And so we've got the Federal Reserve, Jerome Powell, saying, hey, government, you need to kind of get your act together and start spending money and get the economy growing faster than debt. But I know you can't even get a budget together. Not sure how that's going to happen. And welcome back to the show this morning. Michael Lebowitz, live from Washington, D.C., joining us this morning, talking a little bit about Fed, government policy, and, of course, it's interesting, Mike, right now, we kind of just touched on this when you came on the show, impeachment hearings going on. Market doesn't really seem to care too much about impeachment. This whole idea is kind of more a show and go at this point, as you and I have discussed previously. And we did touch on this yesterday, saying that, really whatever happens in the Congress, does Congress impeach the president? Okay, sure. It'll never get through the Senate, so it doesn't really change anything. But we do waste a lot of time and money doing this and not doing things productive, like passing a budget.
Right. But Lance, the market doesn't care about anything.
Yep.
Right. Hong Kong is falling. Hong Kong is a huge problem. Market doesn't care. The trade deal is not going well. The market doesn't care. There's a lot of things that Germany is basically in a recession. They barely missed it by 0.1%. Japan's growth was 0.2%. These are, two of the biggest economies in the world. China is slowing rapidly. Market doesn't care about anything except that the Fed is essentially pumping up the market with their actions. Right.
And again, but that's not really surprising, right? I mean, because after QE1, QE2, QE3, the markets went up. Right. So, we've kind of trained investors now. It's almost like Pavlov's dogs, right? Where the Fed rings the bell. Hey, dinner time, QE4 is here. Let's go buy stocks. But the one thing here is that this, the environment now is vastly different. And in QE1, when the Fed started interventions then, the markets were deeply oversold. Valuations on stocks were about 13 times earnings. Dividend yields were running about 2.5%, 3%. And, there was just this very deep depression about stock ownership. Nobody wanted to own stocks. Nobody believed in the economy. Everybody believed the economy was about to fall apart and the world was going to zero. So you had a lot of pent-up demand. So when QE1 hit the markets, QE2 hit the markets, that brought investors back in the market. There was a lot of pent-up demand, a lot of, money that was not invested in equities at that point. So there was this big push in the markets. Now you take a look at the economy and we've got, record low levels of cash by investors. You've got, pretty much valuations trading near 30 times earnings on a trailing basis. So, lots of excess valuations. Everything's kind of diametrically opposed to what it was in 2009, 2010, 2011. But yet investors think the same outcome is going to occur by the Fed doing the same action.
Right. It bodes well until it doesn't. I mean, as long as everyone believes in this fairy tale that QE will support the market through whatever news comes, it will probably work and the market will grind higher. But it's hollow. Corporate earnings have been declining. They were boosted recently by the tax cut, but the benefit of that as far as growth goes is long gone. The economy is expected to be 1% or lower by both the New York Fed and the Atlanta Fed. They both have expectations now of 1% or lower. There is no economic growth. Corporate margins are shrinking. Investors though, are just buying. They're paying more and getting less.
Well, it's the fear of missing out, right? The last time that the Fed did QE, the market went up, and I certainly don't want to miss out this time. And I tweeted out a chart this morning showing the valuations between the S&P 100 and the S&P 500, and the valuation gap is getting very, very large. And what that means, I know that's a little bit technical, kind of financial nonsense, but all that means is that money's crowding in to fewer and fewer stocks. So everybody's pretty much everybody's buying Apple, Microsoft, Facebook, not buying so much of the other companies really in the index. So the breadth or the participation in the market is becoming much more narrow, and that's money crowding and hiding into fewer assets that typically kind of mark the top of bull markets, not the beginning of new ones.
Right. And we're another odd sign is IPOs. The prices of IPOs have been collapsing, which that's something similar to what we saw in 2000. And in the years leading up to 2000, 2001, IPOs were all the rage, and whatever they were IPOing the stock would just go gangbusters.
Right.
And then towards the very end, those IPOs were falling apart. And that's what's going on today as well, is that people are finally seeing that these companies, many of which are not profitable and some of which will never be profitable, are nothing more than Ponzi schemes.
Right. Well, WeWork obviously is we've talked about, that company here on the show a few times now, is, probably the hallmark of, kind of market greed and exuberance. Here's a company that had no path to profitability, just burning cash left and right. And their business model was not anything unique or innovative or technology driven. They portrayed themselves as a tech company, but only because they had a tech look in the rental space that their office space they were renting out. But basically, it was a real estate play, which had very low margins. And investors finally woke up and said, "Hey, wait a second. What am I actually paying for here?" And that's become a huge boondoggle for SoftBank. They're going to lose a lot of money on this deal. JP Morgan's tied in this deal as well. Probably going to be an impact on their books as well.
And they're also, WeWork is the largest renter of space in New York, in London, and I forgot some of the other cities, but some big cities in America and around the world. And it will have a drastic effect on those real estate markets. So,
and I guess just kind of, coming back to the Fed here and talking about fiscal policy versus monetary policy, the issue is that, it was interesting when, Trump, prior to Trump being elected president, right, he actually sent out a tweet saying that when Obama was running $1 trillion deficit, that was a national security issue. Now we're running $1 trillion deficit, and it's the greatest economy ever. Politicians always run on this platform of, especially conservative politicians, always run on this platform that, we're going to balance the budget, we're going to be fiscally responsible. And of course, when they all get up to Washington, it's just kind of, a spending frenzy that kind of goes out the window. there doesn't really seem to be any ability or desire or any mention really of wanting to actually try to structure the debt. We want Donald Trump yesterday talking about wanting to provide a 15% tax cut to average Americans. Great, no problem. Give tax cuts to everybody. That's awesome, but that lowers your revenue for the government. And when you're already spending 96, 97, 98 cents on the dollar just to pay for mandatory benefits, cutting taxes again is going to give you A, an incremental boost to the economy, if at all, but B, just makes your fiscal funding problem even worse.
Right. They're just games to push the economy up for a quarter or two or three. It's political expediency, and you're right. It's both sides of the aisle, and whoever has control of of Congress is the least fiscally responsible, and the other party seems to be the more fiscally responsible, and then it flips back and forth. And it's a lesson to all voters on whatever your belief, that these guys need to get control of the deficit, or we're going to have big problems, because the Fed is already funding the U.S. government by printing money.
Right.
That has never ended well in the history of man, and we're going back thousands of years now.
Right. Well, and again, going back to the fiscal policy statement that Jerome Powell made, one of the rising kind of pieces of commentaries of late has been talking about modern monetary theory, which is basically this monetary theory that debts and deficits don't matter, just issue all the debt you want, and as long as you don't have inflation, you don't have any problem. But, it really is more than that, because it really comes down to the buyer of the debt ultimately, because you've got to sell the debt. To issue debt, you've got to have a buyer. And the question becomes, exactly how much debt can the Fed actually buy before it becomes problematic. So, but this kind of all this idea of the government needs to do more is simply a function. Basically, the Fed telling the government, hey, just go print more debt because we'll buy it because we don't have a choice, but y'all got to do more.
Right. And then what really gets me recently is people that tell you they're not printing money.
Yeah.
And technically they're not printing money. They're putting reserves in the system. But look, the government just borrowed $1 trillion. Where did that money come from? It doesn't come out of thin air. It came out of somewhere, and that's because the Fed is printing reserves, which is essentially the fodder for printing money.
Right.
And they create money. And so, the more money there is, the less it's worth, and the more inflation you get. Now, whether the inflation is hidden by the statistics is one thing, but there is no doubting that the more money there is and the more money there will be, the more inflation and the more social strife we're going to have.
Yeah. And look, and we have a chart. So if you go to our website, realinvestmentadvice.com, I want to direct you to one very important chart in our Tuesday article, which is our Technically Speaking Tuesday article on charts that you don't want to show the bulls, right? Because you need somebody to sell to first. But we have a chart in there of euro-dollar deposits. Now, everybody's going to go, what the hell is that? But that's basically foreign banks, foreign entities, putting their currency into dollar-denominated deposits. And the reason this is an important chart is because that level is now at a record level high throughout history. It's never been any higher. And the point about this is that money is hiding in U.S. dollars, which means it ultimately winds up in U.S. treasuries, which, gives the ability of the Fed to have some cover here. But if that ever reverses, and this is the one big thing about inflationary pressures and interest rates, et cetera, if at some point our foreign buyers say, I'm really not interested in it, I don't believe in the economic stability of the country, and that reverses to a major degree, we could be into real problems in terms of talking about inflationary pressures, interest rate rises, which has tremendously negative effects for the economy long term.
That's right. I mean, that's a disaster for the economy. If the Fed has to raise rates, if the Fed has to reduce their balance sheet because of inflation. They basically, unlike the 60s and 70s, cannot fight inflation without causing a huge depression.
Yeah. and this is the tightrope that we walk right now. So Michael Lebowitz, CFA, thanks so much for joining us today. That wraps up the Real Investment Show. Look, we've got a couple of articles on this on the website, and we've got some more coming out over the next week talking about these specific issues. So make sure and get by the website, realinvestmentadvice.com. Be sure to read Tuesday's articles, our Technically Speaking post on why we just recently added a short position to our portfolios just to hedge some of our long. But there's also more to that story that is concerning on a longer term basis. Also, an article out this morning talking about, can the consumer actually continue to support the economy? That's on the website as well. So again, all at the website, realinvestmentadvice.com. Send us your questions and comments, emails, whatever we can do to help you. Always happy to do it. Realinvestmentadvice.com. Stick around. Chris Salcedo is coming right up.